Hey folks, welcome back to Money with Param, where we simplify money, investing, and economy without the jargon. Just like talking to your older cousin who actually explaining things clearly, right? Today's episode is juicy. Everyone's looking at the Sensex going, wow, 75,000, 76,000, all-time high. But what if I told you that's not the full story? Behind the big shiny headlines, there's a silent revolution happening in small cap stocks. And it's not a joke. Some of them are crushing the market right now. Let's decode it together. What's really happening? Okay, quick recap. The Sensex, which tracks 30 of India's biggest companies, has gained over 6,000 points in recent months. Great, right? Sure, here's the catch. Small cap stocks, are not so famous, lesser known companies have been skyrocketing quietly. While the news screams about HDFC, TCS, Reliance, small companies have delivered returns of 40%, 50%, even 100% in the same time. It's like the underdog team quietly winning the match while the camera focuses on the celebrity players. So, what are small caps? Think of stocks like people in your neighborhood. Large caps are like the Ambanis of the block, rich, famous, everyone knows them. Mid caps are like successful small business owners. Small caps, they are the local startups or shopkeepers who quietly work and sometimes grow fast. They are riskier, but when they grow, oh boy, they explode. Why are small caps booming now? Here's the fun part. It's not random. Some things are fueling this. Retail investors like us are loving small caps because they are cheaper to buy. Strong domestic economy. Sectors like infra, defense, and capital goods are doing well. Foreign investors and focus more on large caps, so small caps are getting room to shine locally. Also, some big investors are rotating money from large caps into small and mid caps. But wait, is it safe to dive in? Let's slow down. Just because small caps are booming doesn't mean every small cap is a gold mine. Some are legit, others pump and dump scams. Stocks manipulated to fly high and then crash hard. So here's Param's golden rule. Don't chase returns. Chase the reason behind the returns. If you want to explore small caps without getting burned, look for small caps, mutual funds, or ETFs, less risky than individual stocks. Study the business. If it makes money, has steady growth, and decent management, it's worth watching. Limit your exposure. Maybe just 10 to 15% of your portfolio, especially if you're new. And always, if something feels too good to be true, it's probably is. Now, I won't name stocks here because I'm not giving financial advice. But if you check returns of defense companies, railway tech firms, or infra related small caps, you will see how many of them quietly delivered 80 to 100% in the past year. This doesn't mean they will repeat the same magic next year, but it tells you that there's action beyond the Sensex. Big indexes like Sensex and Nifty show part of the picture. But if you want to understand the real market pulse, look at mid and small caps too. They're not just the side dish anymore. In many portfolios, they are becoming the main course. And here's the action tip this week. Open your investment app. Check the Nifty Small Cap 250 or a small cap mutual fund. Track its 6 month and 1 year return. Ask, if I had 1000 rupees in this year ago, what would have happened? Not saying jump in, just observe, learn, and think smart. So next time someone says Sensex is up 500 points, ask them, but have you seen what small caps are doing? Because sometimes the quietest corner of the market are the loudest wealth creators. If this episode helped clear things up, do share it with one friend who's still only tracking the Sensex. And hey, don't forget to download the Beginner Investor Toolkit link in the show notes. I am Param, and you have been listening to Param Money with Param. Keep learning, keep growing, and as always, keep it simple.